This is how you can make money in the market no matter what happens with the debt ceiling. There's so much noise going on, so many opinions. Nobody even wants to take a position because they're so uncertain. The reality is you don't need to know the fundamentals, you just need to know the cycles. If you know what places in history are repeating and what happens next from the past patterns, then you can forecast the future, and you will be more correct than trying to listen to all the pundits who really do not know the answer. What's interesting is when the debt ceiling events took place in 2011, they resolved the situation, and as soon as they resolved it, the market fell 16% right after that. And if you look at the end of 2018, the market collapsed into December 22nd, and they actually shut down the government for 21 days after that, and the market went up. So trying to even interpret what will happen to the market if, quote, a good event takes place, let's say they resolve the debt ceiling without shutting the government down, you'd think the market's going to go up. It may not. And if there is a shutdown of the government, indeed, if there is a default on the debt, you think the market's going to collapse? It may not. So to try to interpret these forces in that way isn't correct. However, if you know the cycles that are operating, which we do, and you see where history is repeating, which we do, then you have a much better chance of actually making money no matter what the noise might be on the television. What we said last time was that the market is likely to rally up into the June 20th area, and that it's likely to make a bottom approximately the 22nd, 24th of the month of May, which it seems to be doing. Friday, the 25th, 26th was extremely bullish. And what we see now is there's probably going to be another few days down because they now extended seemingly the amount of time to we still may have money until the June 5th instead of June 1st. Of course, that whole thing is nonsense. It turns out, however, the cycles are in line with that roughly until June 8th, there's a possibility and even a high probability the market will dip some, not a lot, not collapse, not crash, and then rally strongly into the middle of June, either June 15th to 20th area, or possibly have a second top even on July 4th. So it could have a topping region between the middle of June and the early part of July, and then if the market really wants to collapse for even a few weeks, it would probably do so after July 1st and end somewhere in early August. And then we expect the market to go up again into Labor Day. So it's going to be wild. But the second chart I want to show you is an overlay program that we designed for our students of our forecasting course. And it is a simple thing. We just took the data from a certain number of months ago and plop it down on the present data to see if the pattern looks the same and if history is indeed repeating. So here one you see and this one, you see the 323 bars ago on a 240-minute bar chart, and it's been repeating beautifully. Here's the 3-month cycle, roughly 3-month cycle that we've just described without the overlay. Here's another chart that just shows the overlay itself, which is already progressed forward 3 months. And this is the combination when you put the overlay on the chart. Notice it's an extremely good fit. Okay, we did the same thing on a 20-minute bar chart, short-term intraday bar chart, and we looked at the last month, 1 month ago, about 28 days ago, and we put the data from a month ago onto the present data and look at the last few days. They're literally identical. If you knew, and we did, that 1 month ago was going to repeat because the probabilities were high that that cycle was repeating, you could have had an absolutely perfect map of the last 2 or 3 trading days, and it would also tell you likely what's going to happen Monday, Tuesday, Wednesday next week, you see? This is the value of knowing what history is going to do. This is the value of the forecasting. We're having another forecasting course start this week, And it's a 3-month program. We've talked about it, 4 weeks of classwork and 9 weeks of clinic. We call them clinics, question and answer clinics after that. We're looking to get as many students as possible because we're not doing these things very frequently. And I really hope that you guys can recognize the value of this stuff and go for it, because there's so much annoyance in the fundamentals. There's so much confusion. There's so much distortion. Nobody knows exactly what's going on that level. You can find out what's going on the real level, the unmanifest geometry of the market level, and then make some decent forecasts. What I've been doing is I've been showing you these matrix channel lines as one of the inventions, one of the creations that we've come up with over the years. And those particular channel lines are somewhat involved and they're somewhat complex. However, I have another set of channel lines which I'm providing for our students, which are simpler. And here's an example of what we call the matrix channels horizontal, matrix channel lines horizontal, which are very important lines. Again, they're there before the market gets there. They're just unmanifest geometry of the structure of space and time itself, and when the market gets there, it tends to bounce around between them. And here's an example of a chart with some of those lines on it, and there, in the last 15, 16 months, there are at least 20 major high and low points that reacted to these lines, and if you knew that they were there, you would have had a tremendous advantage. These are not normal trend lines. They don't depend upon the data being there. They only depend upon the time factor and the fact that we knew the unmanifest geometry. Unmanifest meaning it's invisible structure to the market.